What's up, guys? Today's video is all about commercial real estate. I hope you enjoy this overview and I hope it makes sense. Commercial real estate. At first, it seems very scary. A lot of people think it's out of reach, it's too big, that there's too much risk, or they just plain don't understand it. Even for most real estate investors, a lot of them have a really hard time from going from single-family homes to commercial real estate. So the question is it really scary? Is it dangerous? Or is it somehow worse than investing in single-family homes or other products? In this video, we're going to cover a lot of things about commercial real estate. Everything from value, everything to how we find deals, how that looks, and risk. And in short, commercial real estate is a much more efficient way to scale and reduce risk at the same time. So we're going to cover this. We're going to talk about it. I own over 2 million square feet at this point of commercial real estate. And a lot of my preconceived notions on how real estate investing in the commercial real estate space would be were wrong. And it ended up being my main business, which is really exciting for me. I love the commercial real estate space, and I've questioned why so many people aren't talking about it, or there's so much information and content out there on single-family homes, but so few on commercial real estate. That doesn't make any sense to me, because you don't need to start investing in single-family homes. You don't need millions of dollars. It is not more risky. And I'm going to cover why and how it works. Okay, so the first place we need to start with commercial real estate is in value. The reason being is value dictates why they're sold, why people are buying, it dictates risk and everything else. And value in commercial real estate is actually what I love about it. The reason being is other investments I have a really hard time understanding. Everything from stocks to single-family homes, the prices seem erratic and not logical. But with commercial real estate, it's actually relatively simple. Value is derived on only two things. Value is derived first off of revenue. In commercial real estate, we have lingo like cap rates that a lot of people may not understand. All the lingo, financial lingo around commercial real estate is really to discuss and talk about the revenue. Is it going up? How much money am I going to get to keep in my pocket? Commercial real estate is nothing but an investment. So when you buy and trade it, it is on how much that investment will return to you. That's all a cap rate is. When you're looking at a cap rate is simply trying to describe whether or how much you will make if you buy this investment. We exclude debt here. So if I pay X for this property and it returns X, that is the cap rate, so to speak.
I get it now.
Let me give you an example. High cap rates generally mean I'm making a larger return. So think about a cap rate that's a 0 is theoretically break even, right? You're not making any money. So the lower the cap rate goes, the lower that investor will receive on their overall return. And the higher it goes, the more cash flow they'll receive. At first, it seems very simple.
Okay, well then I will simply just try to buy high cap rates, and low cap rates are bad.
But that's not exactly true, because cap rates are derived purely off revenue, and that's our number one point of value. But we also include the second point, risk or safety. Really, I think of it as stability. The stability of that revenue coming in and the likelihood that that revenue will come in 5-10 years. So when we look at assets, investors are looking for return and safety. Cap rates are supposed to represent these two things combined. A low cap rate theoretically should mean that that is a more secure investment that is going to deliver that return for a long time. Me as an investor, if I think that the cash flows from this asset are going to be very risky and they may not be around for the next year or the year after, I'm not going to pay a high price. That means I need a really high cap rate so I can make as much money as I can, because that revenue is not stable, not consistent, or I do not believe it may have a good future. Maybe that revenue will drop. So I need to offset that on the purchase price, because I need a higher return to make my money back quicker to offset for risk. If I think that an asset is really, really stable and will deliver a great safe return for years and years to come, and I also believe that revenue will go up for years and years to come, I'll pay a really high price and a low cap rate because I know that over time, my income and my return off that asset will be going up. So in 10 years, what I purchased at a 4 cap will be a much, much higher cap rate based upon what I paid for it, because the revenue is increasing. Therefore, my overall return is increasing year after year. The reason this is important is because this is how we evaluate and how we find opportunities in commercial real estate. And not all investors see things the same way. I know we didn't when we started out. When we started out, we were buying storage facilities in smaller markets from mom and pops, and we were paying 12, 14, 15 caps. Now, at the time, storage facilities weren't a very good investment, or they weren't perceived as a good investment, let's say. Banks didn't even like to lend on it. They thought that it was a riskier asset. That fundamentally made no sense to us.
Makes no sense, Allison. Look, okay, you're being irrational.
In fact, we thought the economics behind storage benefited storage, that it was more secure. People never thought that individual would default on their home before they defaulted on a storage unit, which we thought, of course, they would. One, you got to pay $1,500 a month for, the next you got to pay $50. And if I lose my home, where do I put my stuff? So we looked at this as almost kind of like a weird arbitrage in the market. We had to get over hurdles with financing and terms because that was a lot harder to come, which justified that. But instead, we would do owner carrier or owner financing. We would make the owner of the facility we were buying it from actually carry that debt. And we made it non-recourse. So we were buying high cash flowing assets with really low risk. That was a wonderful time for us in our business because we felt like we found this magical misunderstanding and inefficiency in the market. And it was derived from the fact that we believed that the revenue would increase, but we also believed that it was really stable. So how did the market miss this? Why did the market miss this? It missed it for two reasons. First reason was self-storage was so new. Not a lot of people really understood it. But more importantly, self-storage had never gone through a credit cycle. It had never gone through a big credit downturn, and no one knew what would happen to this asset class.
Lori, what is gonna happen? I don't know.
It's a new asset class. It really came around in the 70s and really came about in the 90s. Now, it's the belle of the ball. Everybody wants to know it. But I think of self-storage as like now, it's a teenager.
It's inevitable. I am a teenager and this is America.
It's an adolescent, right? It's not fully grown. At the time, which we were buying other commercial assets, like office buildings, they were secured by long-term contracts, okay? So you would have someone that would lease an office, or I could have retail that I could lease to a Kmart or a Sears for years, and these were the biggest companies in the world. Of course, they were gonna pay. They would never end and never default. They were super secure, and people were buying them at really, really low cap rates. As we can see from the future, a lot of those things turned out very, very poorly. Turned out good for us. Technology started to change how much revenue you could get, but also the stability from it. As people were doing this massive shift that has occurred over the next 20 years, what I call this new era of real estate investing, the perception of how much revenue you can get from office space, from retail, from hotels, has changed dramatically due to the Great Recession and due to COVID-19. But it's really put into question the stability of the cash flows from this asset class. Now, I know I'm going in depth, and I know you may even be saying, AJ, this is kind of confusing, but I'm giving you context to boil it down to the simplest thing. In commercial real estate, the only thing that matters is cash flow. Just revenue. And when we got into the real estate game, I didn't understand real estate. I didn't get equity. My friends and people I knew were becoming millionaires buying and flipping and doing things with single family houses, which didn't make sense to me because I didn't understand where value was coming from because there wasn't cash flow and it was just mystical stuff. And I was just too dumb to understand the equity game at all. So I needed something that was very straightforward. I was in cash businesses. So I needed to look at a cash flow. How much am I going to make off of it? So because of that, I skipped all the other assets and went straight to commercial real estate. Me and my partner, who was my father, we needed depreciation. We needed all those benefits and advantages of real estate, but I needed to know value. I'm not a gambler. I need easy, predictable, logical way to underwrite and value what I'm investing in. Commercial real estate offers that. It is a much simpler way for you to decide whether you should be buying it or not and understanding exactly the income you're going to make from it. When we got started, I have to keep things simple because that's how I operate. And I needed things to me that were very safe, predictable. I wanted to compound my returns because I wanted to build an empire.
You don't build an empire off a 1.4% cut of a 15-cent hamburger.
And I couldn't do that unless I could project out and know how much my money was going to return, how I could get it out, and how I could redeploy it, and at what rate I was going to make money after I deployed it, right? And I wanted to map it out on a piece of paper. So when we looked at finding value in commercial real estate, we looked and I created basically two philosophies. We have two types of value that I'm trying to buy or trying to find, let's put it that way, in the market. We have given value, then we have earned value, or value you create. Let me touch on these two things, and it sets the stage on why this is important to understand moving forward here in this conversation. Given value is discrepancies in markets due to owners. Normally, this is found in discrepancy for rates. So let's say that I buy an office building who all the tenants are paying $15 a square foot. Now, in this exact same market and like-minded assets, other office buildings are charging $20 to $25 a square foot. When you look at this and say why, it may not have anything to do with the marketplace. It may have a lot more to do with the owner of that asset. Lots of owners don't like to give rate increases, or they're so hands-off and they're so passive they don't even pay attention to it. They're just bad operators. So you can buy that asset at $15 a square foot, and then you can increase it to normal market rates. So I'm going to look at the term of the contracts when they come up. Maybe 50% of the building is going to come up in the next 2 years. That means in the next 2 years, 50% of my revenue, I'll be able to increase by 30%. So if I go in and I pay a 4 cap for that, in the next 3 years, my net income will explode.
This place is about to explode.
In return, my value explodes and grows massively. We're going to talk more about that when we come to financing a different period. The point is, it's measurable. It's easy for me to understand. When I was buying storage facilities, some operators were operating at 50 cents a square foot and others were operating at $1. The product was exactly the same. There was no difference, and they were right down the street from each other. It made no sense to me. It was like arbitrage. That was value that the market just gave to me. I just bought it and put the rates at where the market should be. There's other ways to find given value that we'll talk about in other videos, but that gets you the idea of what given value is. It's already there. The market did all the work for you. You just buy it and take it. That's how I started out. I wanted a sure thing. I already knew demand was high. I knew rates were at that spread between that asset and the overall marketplace and what it achieves was my given value. Number 2, created, earned value. Earned value is different. Earned value is the things you need to do to make that revenue go up. Now remember, when we're talking about given value and earned value, the whole focus is on improving revenue. Therefore, improving the overall return you get and the overall value of the property. Now, earned value came a little later for me. This came as we built out operations. This came as we found out ways that we could do intense revenue management with assets. This came as we started to do expansions and we would start to remodel buildings. The most clear and noticeable earned value in commercial real estate is development. So development, there's nothing there, and I need to build something that's new. And lots of times that may not even exist. And I'm trying to capture a higher value that exists in the marketplace. This is why most people view development as speculative. There's not a lot to measure, and at the end of the day, you're kind of making up numbers that you think are achievable. It doesn't mean that it's not true. I'm a developer. I develop. But let me give you a clear example of this. Malls are dying, right? So all across America, we all know that malls are dying. I live in a metropolitan area that has a mall that has vacancies all over the place. We heard that a developer was coming in and developing a massive mall, which at first glance, that makes no sense. Why are you developing a retail center? Revenues are going down and they're not stable at all, so that is a really poor asset. What they did though was they changed the offering. They made it an outdoor mall. They added more amenities that people would gather, and then the actual retail side of selling goods to customers was the sideline. They made it outdoors, they made it beautiful, they put in housing over the top, and they created something that everyone wanted to be around. All customers wanted to go to it. So they attracted the people bought things. There was movie theaters, there was restaurants, right? It was a beautiful location for the community. It was still a mall, but it was not perceived as the same thing at all. The rates that they could demand out of it were multiple higher than the other mall, and people were clamoring to get in. It was a place where people gathered. That is a perfect example of earned or created value. They gave something to the marketplace that they knew they needed, and they could do it at a much higher price. So, now that we've talked about commercial real estate, how we get value, what we look for, and how people in commercial real estate generally create or earn value, now we're looking at what I call the commercial real estate wealth cycle. And this is a process that we've used to build, buy, and create a portfolio of over 150 million in assets. This wealth cycle is very simple. We buy assets that we have given value in, so I can measure how much that revenue will increase. There, we increase through both given and earned. We do put our operations, we may do certain things to increase it, we increase the overall revenues. So we go out, we find it, we buy it, we put our model over, we increase the revenue, okay? Nothing special here at all. Once we've increased that revenue, many times we've increased the value of that at multiples more than what we had to put in. Now, this is where things get interesting. So it's important that we talk about risk. And risk is coming up, but I wanted to give the context of the cycle before we dive deep into it. Because at this point in the cycle, I'm going to reduce my risk as well as get all my money out and redeploy it. We pull our money out, we put a new loan on it, we take all of our money plus a profit out, then we go do it again. In single family houses, this is called the BRRRR strategy that Brandon Turner for Bigger Pockets coined. The BRRRR strategy works in commercial real estate, but it works even better. And this is why: lowering risk. So one of the things that I love most about commercial real estate is this aspect of risk. After I've improved my property, not only do I get all my money out plus a profit, and I still own a cash flowing asset that makes good money, I put it into a new loan structure. And that loan structure is called non-recourse. That means the asset backs the loan, but not me. That loan is not personally guaranteed. If things go to pot, it goes under, I give the keys back to the bank, and I just keep doing what I'm doing. They don't get to come after my home, they don't get to come after my bank account, they don't get to come after my property at all. So that means I've now gotten all my money back. I've put that into a new loan, which I'm no longer personally guaranteed for, and it still pays me. Infinite returns.
Oh, that is impossible. May I know the facts?
That's what I call it. Because I get infinite returns and I've eliminated almost all my risk. The risk that I have on the property is, of course, it could go down to nothing. And people say,
Well, you lose your investment.
but I've already got my investment out. I'm protected against unknown events that I can't predict and that happen. We know they happen.
Because life happens.
So the capital extraction plus the reduced liability allows me to do the next thing that I love about commercial real estate: scale. Commercial real estate is wonderful for scale. The reason being is, in scale, we have two parts of scale. The first one is volume. You can scale by volume. I can sell more products, I can buy more houses, and the more that I do, the more I'm scaling up. My business is growing. This is a volume game. I need more and we have to do more. I've never liked volume games. The next part of scale is magnitude. That means you do one and you sell another that's even bigger. And then you go bigger and bigger and bigger. You may not be doing as much, you may not be selling as much, but the total amount, the magnitude of that sell, the magnitude of that transaction has grown. In commercial real estate, I get both. I can start small and I can grow big while never losing even the first one that I did. So your scale curve looks like this. It very much follows a compounding curve, and commercial real estate is specifically designed for this. The reason being is the cash flows that pay you, getting your money out, reducing risk, but your ability to move forward in magnitude. What I mean, when we started out, we were buying facilities that were a few $100,000 that were very small in rural towns. Now we're building $20+ million properties in major cities. Our investment style hasn't changed at all. Our overall structure, our management, the lending practice, the way we do business hasn't changed. But instead of a $400,000 property, I have a $40 million property. So I'm still doing the exact same thing here that I'm doing here. And you can do this quickly. We started small. After about our first 5 small facilities, we went up. We went up, then we went up again. And we just kept growing larger as we could sustain it and we're comfortable with it. So commercial real estate, my favorite part about it is your ability to scale. Now, people view either getting bigger, having more assets, having more debt as liability. But remember, I'm shedding liability as I grow. Today, with over 150 million in assets, I have less liability than when we first started with those few facilities that were worth hundreds of thousands. This is exceptional in business. It allows you to grow even more, do more, and get bigger. Sellers, banks, they all give you better terms, they work with you more, you get more deals as you grow. So it compounds in every single aspect.
The tougher you are, the more people respect you.
The next side of this is why get started in commercial real estate? Obviously for all the reasons that I've already stated, but the idea that I can't, that I need a lot of money. This is where I think the opportunity in commercial real estate is. For commercial real estate, as of right now, most of the players that are in commercial real estate, these are funds, institutions, these are big guys.
Exactly, that's why I'm not getting into it.
And I say, no, you're missing the opportunity. In commercial real estate, the amount of assets that are under 5 million is staggering. They're everywhere. You have them all over your town and all over America.
Thousands of them all over America.
Yet me, as well as other institutions and funds and people that get great terms on debt, everything, they're not buying them. It's not worth their time for them to go buy a $2 million asset. I can't do it because it's a poor use of my capital and my resources. That's part of my scale. It doesn't make sense to trade a $40 million asset in work and time and effort to do a $2 million. My returns drop, efficiencies drop, so we don't do it. For individuals starting out though, they can get it all. Not only can they get it all, for me, there's opportunity, there's less competition. And this is the next part about it, ownership. The people that own those assets are usually mom and pops. Remember when we talked about value at the beginning? You can grow value through growing revenue or stabilizing the revenue. Mom and pops are notorious for having stagnant revenue and not being hands-on. There's much greater opportunity to grow the revenue from a mom and pop and stabilize it than an institution because they're already doing a good job. So what does that mean? Starting small, you have higher yields. Anyone that's starting in commercial real estate today is probably going to get much higher yields on their investment than I am today doing big ones. Now, this is hard to understand because it doesn't seem to make sense or it's counterintuitive, but it's true. When I started, my deals yielded higher returns than they do today because I deal in magnitude. not volume. Getting into commercial real estate is a better opportunity than getting into the stock market, single family homes, or other assets where everybody's going after the same thing. They're all fighting for it and they all want it. This is untouched for the most part. And I think for an investor, especially in real estate, it offers the best opportunity to create wealth and income over any other asset class out there. Okay, if this was helpful, let me know. And how do you let me know? The currency of YouTube. Like, subscribe, comment. That is what gives me exposure and helps me. We try to put out this great content, and if you think it's valuable and you like it, please help me out and I'll keep making more.